Hello, everyone. Today we are talking about typical mistakes made by retail investors. I use an acronym for that. I call it TRAP. It's TRAP. T, trading, too much trading. Um, Retail investors, they seem to ordinarily trade too much. What they don't understand is that trading too much, it bears a cost. There are transaction costs, there are opportunity costs, there could be timing costs as well, market timing costs, because it is very, very difficult to time the market consistently um, with success. Very few people in the history of the market have done it. So to me, it's time in the market rather than timing the market that differentiates successful investors from short termism. Um, the other thing which is quite common, which I have sort of observed within the retail audience, is poor risk management. So, risk management, uh, when a professional investor goes about building a truly diversified portfolio, the very first thing a professional investor thinks about is risk. On the flip side, when a novice investor is building a portfolio, the very first thing they, which is at the forefront of their mind is how much money can I make out of it? Professionals, pros don't think like that. So for pros, the initial starting point is how much risk am I able to stomach with this investment? Am I going to able to sleep, or am I going to lose my sleep if my portfolio is down 20-30%? Once we've had this discussion, then you move on to the next step, which is objective, etc. So the retail investors' risk management needs some refinement, some serious refinement. The third mistake, which is quite common, is asset allocation. They, at the time of putting everything together, they come up with a certain split. For instance, 50% in equities, 20% in fixed income, 20% in alts alternatives, and remaining 5 to 10% in cash. But as time goes by, they end up with very, very different weird asset allocations, and they don't understand that they need to bring this portfolio back to the target strategic asset allocation, which can only be achieved by having a disciplined rebalance approach. What does rebalance mean? Rebalance simply means trimming your winners and adding to your laggards. This is exactly what rebalance is. So, having a well defined structure around rebalancing, you could do it on a monthly basis, on a quarterly basis, or a semi annual basis. But having a well defined structure is quite important. And the final thing in my trap approach is performance chasing. Retail investors tend to buy stocks or indices which have done well. They look at the last 12 months performance and say, oh, this has done well, so we should be buying that. Shrewd, sophisticated investors don't think like that. One of the key tenets of investing is you buy low and sell high, if that makes sense. So, but with retail investors, it's normally the other way around. They tend to buy when the market's valuations are quite stretched already. Um, and sometimes they sell at the wrong time due to emotional or behavioral biases. So today's live, these are the four key reasons, and in my view, these are the four biggest mistakes retail investors make when running and managing a portfolio. Um, if you have any questions, feel free to drop them in the comments, and I will, get back to you ASAP. But overall, I think that's about it. These are the four sort of key reasons which I've noticed. I will reiterate, this channel is all about promoting financial literacy in the UK and beyond. I'm not a trader, I'm not a day trader, swing trader. I am a long term investor. I work as senior investment analyst, but I am speaking in a personal capacity. This is not advice, purely educational. all the videos, all of the videos, there's quite a bit of information on the channel if you can check out. It's all about promoting financial literacy. And yeah, I think that's about it. If you have any questions, as I said before, feel free to pop them in and I'll get back to you. Hope you enjoy the rest of your evening. All the best. Cheers.